This is an analysis from Alpha Business Media. Welcome back to the deep dive. If you've been watching e-commerce in places like Nepal, you've seen the headlines, you've seen the big number.
Exponential growth.
Exactly. And the one metric that always gets thrown around, the one investors love, is gross merchandise value, GMV.
It paints a picture, for sure. A very flattering one.
But our sources today suggest that underneath all that growth, there's a structural flaw, a kind of toxic secret.
It's a dependence, really. A crippling reliance on cash on delivery, or shitter. And that's what we're digging into.
Because when almost all your sales are based on, well, zero financial commitment from the customer, what are you even measuring?
You're measuring vanity. That's the argument. The sources show that failure rates, cancellations, doorstep refusals, all tied to COD, can hit a staggering 30 to 40%.
30 to 40. I mean, just stop and think about that.
Yeah. Almost half of the value you're celebrating as GMV just vanishes into thin air. It never becomes real revenue.
So that's our mission in this deep dive. We're going to deconstruct that exact financial hemorrhage.
Right. Forget the high-level percentages for a minute. We're going to get into the nitty-gritty unit economics of one single failed order.
And we want to show you exactly why that high GMV is really just a mirage.
And, more importantly, what it would take for these companies to actually become profitable.
So let's unpack this, because SEO wasn't always the villain, right? Initially, it was seen as this necessary evil.
A bridge of trust, that was the term. And it worked. People were skeptical of paying online, so this let them see the product first.
And it fueled that incredible adoption, that GMV growth we were just talking about.
It absolutely did. But here's the problem. That tactic, that short-term solution, has morphed into a long-term strategic liability. It just decimates any probability of profit.
The platforms got addicted to the growth metric.
Completely. And they never dealt with the operational toxicity it created. Let's use an example from our sources to make this really concrete. Say, a product that sells for 3,000 rupees.
Okay, RS 3000. Let's look at the two paths that order can take.
On the one hand, you have the healthy path, the prepaid order. The customer pays up front.
So the platform gets that RS 3000 immediately.
Immediately. Cash flow is positive from day one, and the costs are straightforward. You have your cost of goods, maybe RS 2100, a tiny payment gateway fee, 1 or 2%.
And the shipping, say, RS 150.
Exactly. The risk is basically zero, unless the product itself is faulty.
Okay, now for the other side, the CRD order. The platform still has all those same costs, right? It still has to buy the product, pack it, ship it.
All of it. But it's doing all that based on nothing more than a promise. A completely non-binding, zero-consequence promise from a customer.
You're sending out real capital, real inventory.
On the hope of future revenue. Revenue that has, as we said, up to a 40% chance of never materializing.
If the customer cancels mid-transit or just says no thanks at the door.
Poof! That RS 3000 in GMV evaporates. It's gone. And what you're left with is a pile of hard costs you still have to pay.
This is the part we really need to break down. Because the loss isn't just one shipping fee. It's a cascade.
It's a 4-layer financial wound.
Layer 1, the logistics.
Yeah.
You pay about Rs 150 to send it out.
And then you pay another Rs 150 for it to come all the way back.
So that's Rs 300 in cash, just burned, gone, with zero revenue to offset it.
And that's just the obvious cost.
Yeah.
Then you get to layer 2, the reprocessing cost.
Because these return packages aren't handled with white gloves.
Not at all. They get tossed around. So an employee has to receive it, inspect it for damage, maybe repackage it, update the entire inventory system.
Which is a real labor cost.
Yeah.
Our sources estimate around Rs 50 per failed order.
It all adds up. And then you get to layer 3, which is what they call the silent killer.
Inventory lockup.
Exactly. That product, worth, say, Rs 2100 in capital, is stuck in transit. It's a non-productive asset.
For how long? 3 days? A week?
Would be 3 to 10 days for the whole round trip.
Huh?
And for 10 days, you can't use that capital to fulfill a guaranteed prepaid order from a serious customer. It's just stuff.
A huge drain on working capital.
A massive one. And finally, layer 4, wasted customer acquisition costs. Your CAC.
You paid for that click. You paid for that social media ad that got the customer to your site.
All that marketing spend was meant to acquire revenue. Instead, you spent it to acquire a negative margin transaction. It's a total loss.
So let's sum this up. You have the Rs 300 in 2A shipping, Rs 50 in labor. You have the cost of the tied-up capital and the wasted marketing.
You're easily looking at a direct loss of Rs 350 to Rs 400 on that single failed order.
And to put that in perspective, on a Rs 3000 product, your net profit might only be a few hundred rupees.
Right. So that one single failure completely wipes out the entire net profit from 3, 4, maybe even 5 successful deliveries.
You have to run 4 times as fast just to stand still.
It's a financial treadmill. And it leads to the big question. If the math is this bad, why does anyone do it? Why do investors keep funding it?
That's a fascinating point. It's about the incentives, isn't it? The VCs are playing a market share game.
They want to see that top-line GMV number go up and to the right.
Right.
They see the operational losses as just the cost of growth.
And the C-suite gets addicted to that vanity metric because that's what keeps the funding coming in. They're afraid to turn off the tap.
But if we only look at this through a financial lens, we miss the real story.
Okay.
This isn't really a logistics problem. It's a behavioral economics problem.
What do you mean by that?
CO completely removes all friction and all consequence from the buying decision.
Okay, explain that. When I pay with my digital wallet or credit card, I've made a decision. I've committed. My default is to accept the package.
Precisely. You've performed a conscious financial act. With CI, the entire decision is deferred. It doesn't happen at checkout. It happens when the delivery person is standing at your door.
And at that point, saying no is easy.
It's the path of least resistance. There's no cost, no penalty. You don't even have to call customer service. You've trained the consumer to see the purchase as just a casual reservation.
And this zero commitment model, it enables some really bad habits.
Some truly destructive patterns. Let's start with what they call competitive ordering.
Okay.
A customer wants, say, a new pair of headphones. They see it on 3 different websites.
So they order it from all 3 on SIA.
Exactly. And they think, I'll just keep the one that gets here first and refuse the other 2.
Meanwhile, the other 2 platforms have paid for marketing, for packaging, for two-way shipping. They're essentially subsidizing that customer's shopping spree.
Then you have my favorite, the mobile fitting room, especially in fashion.
I can see this one coming. You order a dress in 3 sizes and 2 colors.
Fully intending to only keep one. You're using the company's capital and its entire logistics network as your own personal free changing room.
And finally, just plain old impulse buys.
Yep. You see something cool at midnight, you click buy. 2 days later, the excitement is gone, or you realize you can't afford it. With CA, there is zero barrier to just saying, never mind, no money was ever spent.
Now, the industry always pushes back on this. They say it's about the trust deficit, that people in Nepal just don't trust online payments.
And that's becoming a convenient myth. A convenient excuse, really. The infrastructure is there.
You're talking about the digital wallets.
Absolutely. Networks like PhonePe, Kalti, Iswa, they are used for everything. People pay their utility bills. They pay with QR codes at the smallest street vendor.
So the comfort level with digital payments is already there.
It's proven. The issue isn't that consumers are unwilling to prepay. It's that they are not incentivized to prepay, when this completely risk-free side hot option is just handed to them for free.
Which brings us to the next logical step. If the tech is there, what would the transition away from FICUD actually look like?
For that, you just need to look next door to India. They went through this exact same painful chapter a few years ago.
The big players. Flipkart, Myntra.
All of them. They saw the same explosive GMV, but then the costs of returns and the cash flow toxicity got so bad that they realized FICUD wasn't just a problem as an existential threat.
So they knew they couldn't just optimize their way out of it. They had to change customer behavior.
And that led to their famous push and pull strategy.
Okay, let's start with the push. How do you push people away from something that's free and easy?
You introduce friction. You introduce cost. They started charging non-negotiable CA fees.
Just a straight-up surcharge for choosing cold.
Yep. Usually around 50 to 100 Indian rupees. That's about 80 to 160 Nepali rupees. And it was a psychological move. It reframed Twiscod. It wasn't the default anymore. It was a premium service that you had to pay for.
But wouldn't that just drive customers to your competitor who doesn't charge a fee? That feels like a really scary first move to make.
It is. That's the tension. But what the fee does is it immediately segments your customers, the casual browsers, the competitive shoppers. They think twice.
But the serious buyers.
The serious buyers, the ones who actually intend to keep the product, are more willing to pay it. So you're trading that low-quality, high-risk GMV for higher-quality, profitable revenue.
Okay, so that's the stick. What about the carrot, the pull to get people to prepay?
This is where they got really smart. They re-engineered their whole system to create this powerful incentive loop for prepayment. For starters, prepaid orders got prioritized fulfillment, faster dispatch, faster delivery, guaranteed.
So you're rewarding them with speed.
Speed and money. They offered exclusive, prepaid-only deals. early access to big sales. Digital payment became like a VIP pass,
And what about returns? That's always a big friction
a
point.
huge one. And they made the experience vastly superior for prepaid customers. If you returned an item, you got an instant refund right back to your bank account or wallet.
And for shoes customers.
It was slower. Often you'd only get store credit or a voucher. It traps the customer's money with the platform.
That's clever. The seamless instant refund becomes a massive selling point for paying digitally.
It really does. And the lesson for Nepal is that the pieces are all there. The PhonePe network is basically their version of India's UPI. The infrastructure is ready.
What's missing is the strategic courage,
That's it. The courage to actually implement the push and the pull.
which really brings us to a fork in the road for the whole industry there.
It really is. Path one is the current path. Just keep burning cash, keep chasing VC funding, and have a market that looks big on paper but is, well, it's hollow.
And path two.
Path two requires one major player to have the audacity to say enough, to break the dependency. It's not a tech problem, it's a leadership problem.
So what are the actual steps? What does day one of this pivot look like?
Day one, you introduce a non-waivable SCOD handling fee, just like the Indian model.
Yeah.
You explain why.
And at the same time, you aggressively reward the alternative.
Aggressively. Guarantee priority shipping for prepaid. Offer a straight 5% discount for digital payments. And then you market the hell out of your superior, instant, hassle-free returns process for prepaid customers only.
So the marketing message has to change completely. It can't just be, we accept digital payments.
No, it has to be pay now and unlock priority benefits. You have to frame prepayment as the smarter, better premium way to shop.
What happens next? The immediate reaction has to be painful.
It will be. Your GMV will dip. Your competitors will point and laugh about your new fee. Your board will get very, very nervous.
That's the moment of truth.
That is the moment. But if you hold the line, the benefits are huge.
Because that drop in GMV will be from the low-quality customers.
Exactly. And it will be immediately offset by a massive drop in your failure and cancellation rates. Your working capital efficiency will shoot up. And for the first time, you'll have a real, credible path to profitability.
You're trading hollow growth for healthy revenue.
That's the choice.
Yeah.
Which is why we'd argue that profitability in Nepali e-commerce isn't a logistics problem or a technology problem.
It's a courage problem.
It's a courage problem. It's the C-suite being addicted to a vanity metric and being afraid to be the first one to make the same long-term move.
Which brings this whole discussion full circle. The first company that does this, that sacrifices that short-term GMV, they won't just build a sustainable business for themselves.
No, they'll change the entire market. They'll force everyone else to follow, and they'll redefine the industry on healthier terms.
So as a final thought for you, the listener, to take away from this,
I think it's about looking at any high-growth company anywhere in the world and asking a simple question. What are you actually measuring?
is that metric healthy?
Right. If your whole model is built on a number, like GMV, that pushes you to maximize sales while also guaranteeing you lose money on a huge chunk of them,
Mm-hmm.
how do you defend that? What are the hidden risks, like a reliance on free sod that you're just not accounting for?
That's the strategic question that every leader in these emerging markets really needs to be asking themselves today.